Hi, I'm David Witter. Good to see you again. Thank you for joining us for Dare to Be Different, a journey towards peace, freedom, and wisdom. And we hope that you got a lot of value from last Thursday's breakfast with us. And we thought we'd take a couple moments here to share with you what were some of the key aha moments that we got reports back. We've been getting some great feedback. Thought it'd be great to spend a couple minutes with you and share some of those aha moments and deepen the narrative a bit. So the first thing for our aha moment was the difference between fiduciary and suitability. And I thought a quick example would be a good way to show this. So here you can see the fiduciary standard, where you as the client will engage in a legal agreement with a fiduciary where you agree to pay compensation, and the fiduciary delivers back, in our situation, a wealth management planning solution to you. And in terms of investments, what that looks like is out in the world of investments, there's literally thousands to choose from. And as part of that compensation, the fiduciary will then recommend certain investments that would be the best fit for your plan. So you can see here that the fiduciary is helping you to build that plan and then execute that strategy to be successful over many decades. Conversely, a suitability situation, what shows up is your agreement, you as the investor or the client, is actually with a brokerage firm. And then the brokerage firm has an agreement with the so-called advisor. But notice the big difference here is with the investments. There's only a handful that brokerage firm may actually work with. And then the compensation is where there's something called revenue sharing or commissions paid from the investment firms that you, the investor or a client, invest in. Those commissions comes back through the investment firm and then out to the advisor in the form of commissions. So you can see here a very different fundamental setup and often leads to a lot of conflicts of interest. So that was the first aha. Why would I want to work with a fiduciary versus somebody held to a suitability standard? Second were some of the flaws of indexing. And the first one we talked about was impurity. So here we can see the diagram where the index fund would own the green balls that would be at the first, when they was first constituted, all collected there at the bottom. But over time, some of those securities or some of those investments, some of those individual stocks will move out of the index list. In other words, it no longer meets the criteria. And this is what we would call an impure asset class. Well, you might be wondering, well, David, why would I care? Why does that matter? What happens when there's impurity for some of your asset classes is it tends to drive up the risk, and it's risk that you really aren't aware of, or even your advisor's aware of. And then secondly is a lot of times it will decrease the overall performance because again, it's not the purity of the asset class that we're trying to track. The second one that be a flaw with indexing is something called reconstitution. So here we can see we have an index going along with this investment. And then the declaration date comes out when the index declares we're going to drop these certain stocks, in other words, sell them, and then we're going to add these other stocks to the index. So let's say Standard & Poor's makes their announcement. They say we're going to buy ABC or add that to the index, and we're going to get rid of X, Y, and Z. Well, imagine the moment that that's announced by the index firm, Standard & Poor's in our example, there's immediate upward pressure on what's going to be bought by all the indexes, and there's immediate downward pressure on all those stocks that the index has to get rid of. Notice that's a pretty serious problem because down the road, your index buys and sells what was announced by the index. And the problem with that is you will tend to overpay for those that have been announced as a purchase or an addition, and you're going to be selling in downward pressure for those that have been deleted from the index. This is called the reconstitution effect, and it's a real negative or a flaw with indexing. The last aha moment is what are some of the benefits of working with the third approach, which is evidence-based that we focused on. First is it gets rid of the impurity of the asset classes, and it also gets rid of the reconstitution effect. The second one is something called flexible trading. So again, the best way to explain this is an example. So let's say that Bob and Ted are in the market to buy a convertible, but Ted is very specific. He has to have the yellow sports car convertible, and so he's willing to pay a premium and will have to pay a premium for that. However, Bob does want a convertible, but he's a little bit more flexible in the specific convertible that he buys. So what does this look like? Notice over here, Bob really has 6 choices. Ted only has the one that he's chosen that he must have. Well, in the world of investing, what that looks like is if you have certain or number of stocks that meet your criteria, you can be very flexible when you purchase those and you can pay less for them. Whereas if you're an actively managed mutual fund or a hedge fund or a stock picker or a stock broker, you have one specific stock or a handful that you really like and you're focusing on those, you tend to overpay or pay too much for those individual stocks. So what now? For our existing clients, if you're watching this video, we hope that the Dare to Be Different and this little narrative here gives you even greater peace and more discipline with your investment strategy. And if you're one of our guests that came, again, we offered a 360-degree financial assessment to make sure that you are on the right path to be successful with your plan. And if you are on the right path, we'll tell you that, you get peace of mind. If not, we'll explore what are those options and that gap analysis to get you to passing your rocking chair test.